Alright guys, so got a bit of a cold, so try to speak as clearly as I possibly can. People have been asking me about the tick charts. I keep going on about the tick charts. I prefer tick charts over time based because there's a lot of reasons. Obviously, tick charts give you more data in terms of order flow and where orders are coming into the market, how the market's reacting to those orders. You can get a lot of information off the time based charts, such as 5 minute, 10 minute, 15, so on. But what you've got to also remember is every if you're using a 5 minute chart, every 5 minutes that bar's going to close regardless of the action, regardless if there's buying and selling pressure in the market. After 5 minutes, that closes, um, and it's not actually giving you a clear enough. It's giving you a clear pitch, but not a clear enough picture compared to the tick charts. The tick charts are based on a set amount of orders or trade volume, should I say, that's actually taking place in the market, and it gives you a better reflection of actually what's happening, where the proper supply and demand is. Now, you can draw supply and demand on time-based charts. There's no problem with that. You can trade it pretty successfully time-based charts, but in my opinion, you're better off using tick charts if you've you've got it available to you. Now, everybody should have it anyway. So there's two ways to actually trade the supply and demand, or two different styles. One's the really short term, and one's the slightly longer term. Both are day trading, but one can also be used for swing trading as well. So the two charts that I use for the DAX, this is only for the DAX because you can't just use the set amount of ticks for every single market. But for the DAX, I use a 10,000 tick chart, which is on the left hand side here, and on the right hand side, you've got the 287 tick chart. So we'll look at the first of all, we'll actually look at the 287 tick chart. So if I just expand this, everybody should know how to draw supply and demand anyway these days, but or proper levels, proper reversal points, and so on. Now, proper reversal points is areas where the market is either gapped up strongly, gapped down strongly, or pushed away from a small consolidation or a single bar, single print bar extremely strongly. It could be one large bar, it could be multiple large bars, but you're always looking for the fast move away, not extended periods of consolidation such as here, which is extending and it pushes away. This is the supply point here, okay, because basically what we've seen here is a small consolidation period, well, a larger consolidation period here, but then price starts to drop away here, and then it pushes away fast. Okay, so this is the first supply point. This was on the 21st of March, or the first area that you'd be interested in trading. Okay, next point is down here again. You can see there's lots of consolidation here, lots of order flow in the market here. As price grinds its way up, but then eventually pulls back towards that zone and collects some demand, and then pushes away quite fast here. So then we would take this little consolidation period here as it fed off of this prior order flow here as your next point of area of interest, and this would be your demand point. And again, this demand was tested yesterday around 5 o'clock in the afternoon UK time. Okay, and again we can see a double tap of the prior supply point. Now I don't particularly like trading supply and demand twice. If the zone's been tested twice as an absolute maximum, and the reason for that is every time you've got a zone and it's tested for the first time, you've got to assume that the vast majority of orders that were sitting there were chewed up, were eaten into. Okay, and then if it tests it a second time, you've got to assume that they're all gone. Alright, so the rule the rule that I always go by, you've got to assume the first test takes about 60%, 60 to 70% of the orders on the first test, and then the second test usually takes the rest of it. Okay, if it doesn't cleanly break through it in the second test. So I definitely would not trade this zone for a third time, because you've got to assume that all the others are now gone. Now you can see here as well that when we first originally test it and we sell off, we come back to it and we go deeper into the zone, we almost actually clear the zone. pretty much at the top of the range. So you've got to assume that all the orders that were sitting here have now been totally wiped out, unless they're fresh orders, which I don't know, but you've got to assume that those orders are gone. So you definitely would not trade this zone a third time, for instance. Alright, same goes for this little zone down here as well. This has already been tested. We can see a strong reaction away from it. So you've got to assume at least 60 or 70% of the orders are gone. I wouldn't trade this zone a second time anyway. It's too light a zone for me compared to what this zone was. It came off the back of a consolidation after a prolonged down move. So I definitely would not trade this zone a second time, and I certainly would not trade this zone for a third time. The other areas on a 287 tick chart, there's actually there's an area here that is pretty interesting on the chart, just but I haven't marked off. Again, we can see uh, prolonged down moves in the market, and then again we can see a pullback here. A fairly decent move away here. The only thing I don't like about this is we had this little push back into the market here before it sold off. And it wasn't a great sell off, it was just a consolidation. Personally, I prefer the slightly higher supply point up here, which is around the what's that? It's 12,024, 12,039 area, and then one above there as well, which takes you up to the 12,088 and 12,093 areas that I quite like on the 287 tick chart. Again, these would just be day trading, very very short term day trades. You know, they probably last for a few minutes, up to about an hour maximum. Okay, so the other chart we'll look at here is the 10,000 tick chart, and this is for the slightly bigger trades. And I actually prefer this chart over everything else. This is what gives you the bigger moves, 100 points plus movements in the market. So I've just show you some examples here. And I don't tend to draw zones on these charts, just levels. Okay, so again, it's pretty similar to the 287 tick chart. You're just looking for gaps up, gaps down, strong gaps up, strong gaps down, that is, and fast moves in the market, where you could try and take advantage of short-term reversal points. And we had one yesterday at the 11,850 area. And the reason why I would draw it on that level there is this is the first down bar we see before the reaction up in the market with the gap. Okay, so we can see the down bar, couple of up bars, and then the gap above this level here. And it's a strong move away in the tick chart. It pushes away and it comes back and pretty much to the tick on that level. Now, clearly a selling pressure bar here, selling pin bar, whatever you want to call it, in the market. Again, it's the same thing you do here. It's the first up bar, it is white candle, before I move down in the market. I retest, a gap down, and then we come back and retest it again. So there's clear supply in the market at this point. And previous attempts on the 10,000 tick chart, again, these areas here, and this is an area here as well. The reason why we've got this area again is the first down bar prior to a large movement in the market, a large gap, and then continuing momentum in the market. So when the market comes back to test that level again, we see demand coming into the market. Okay, same down here, it's the first down bar leading or last before a big move in the market here, double movement, double momentum in the market. These two bars, we come back and we get some demand in the market, at least into the gap. Down here, I'm not too keen on this particular level here. I've drawn this level in. But what I would actually do with this level is take it a little bit lower to get the actual gap on this candle here, or this bar here, should I say, and that's around the 11,528 level. Okay, the reason why I would take it from there rather than there is it wasn't a clear move. It was the first down bar before we saw some momentum bars and a small gap in the market, but there was also selling pressure in the market here, if you can just see these bars. Okay, so the real demand for me was here, where the gap was created and the market couldn't refill that gap. So there was clearly buyers in the market here that then created these two momentum bars and then the further gap up So I would have my demand point located on that particular bar. But that's just basically how I look at the 10,000 tick chart.